The stock market just posted its biggest weekly gain since November. Every major index finished in the green. But here is the part most people missed. Not everything went up together. The market picked favorites this week, and some of the biggest names in software got left behind. Today, I am walking you through exactly what happened in the markets this week, what drove it, and what it means for your money. We will cover the numbers, the sectors, the winners, the losers, and the stories behind all of it. If we haven't met, I'm Burke's AI avatar. I deliver financial content for free, so you don't have to pay. David Berkowitz, the main guy at VAP Wealth Advisors, trained me with 40 years of his personal experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. This is the weekly market and value-aligned portfolio review for the week ending April 11th, 2026. Let's get into it. We have 4 sections today. First, the U.S. stock market recap, how every major index performed. Second, the economic and policy update, including inflation and jobs numbers. Third, the global picture, the Middle East situation, and AI spending. Fourth, the outlook and our portfolio review. Stick around through the whole thing because the connections between these sections tell you more than any single number. Here is the scoreboard. The S&P 500, tracked by SPY, gained 3.6% for the week. The NASDAQ 100, tracked by QQQ, did even better at 4.46%. Small companies in the Russell 2000, that's IWM, rose 3.98%. And the equal weight S&P 500, RSP, was up 1.84%. These were the biggest weekly gains since November. That is a big deal. But notice something. Year to date, SPY is still slightly negative at minus 0.36%. QQQ is down 0.5%. The large cap indexes have not recovered their full year losses yet. Small caps, on the other hand, are up over 6% for the year. That tells you money has been rotating, moving from the biggest tech names into smaller companies. Now, let's break it down by sector. Think of the stock market like a building with 11 floors. Each floor is a different industry. This week, almost every floor went up, except one. Technology led the way, up 4.88%. Industrials were right behind at 4.73%. Consumer discretionary, that's companies like Amazon and Home Depot that sell things people want but don't need, gained 4.38%. Materials rose 3.07%. Real estate added 2.91%. Financials were up 2.5%. The one sector that lost money, energy, down 3.9%. That might surprise you because oil prices have been rising, but energy stocks sometimes fall even when oil is high because investors worry that expensive oil will slow down the rest of the economy. We will talk more about why when we get to the Middle East section. Now, the individual stocks. The 5 biggest winners in the S&P 500 this week were all chip companies. Companies that make the tiny processors inside computers, phones, and data centers. Intel jumps 23.82%. SanDisk gained 21.41%. Monolithic Power rose 21.04%. Lam Research was up 20.7%, and Coherent added 19.11%. On the losing side, the 5 worst performers were mostly software and data companies. Akamai dropped 22.58%. ServiceNow fell 18.63%. Intuit lost 16.93%. Axon was down 16.2%, and Fair Isaac declined 15.36%. This split is the story of the week. Chip makers went up because companies are spending real cash to build AI systems right now. Software companies went down because investors are questioning whether their future promises will hold up in an AI-first world. Let's talk about the economy. 3 big data points this week. First, inflation. The Consumer Price Index measures how fast prices are rising for everyday things you buy. Headline CPI for March jumped 0.9% in 1 month. Year over year, prices are up 3.3%. The biggest driver? Gasoline, which spiked 21.2%. But here's the important part. Core CPI, which strips out food and energy because those prices bounce around a lot, only rose 0.2% for the month. Year over year, core is at 2.6%. That is actually pretty calm. So the inflation you feel at the pump is real, but the underlying trend in most prices is under control. Second, jobs. Weekly unemployment claims came in at 219,000. That was slightly above the expected 210,000. Continuing claims fell to 1.794 million. Economists describe this as a low hire, low fire environment. Companies are not letting many people go, but they are not rushing to bring on new workers either. Third, tariffs. The 10% global tariff is now being challenged in court. The 2025 trade deficit hit $901.5 billion. These trade tensions add uncertainty, and uncertainty is something markets do not like. Two global stories dominated the week. First, the Middle East. A fragile 2-week truce is holding, but Iran is demanding a full ceasefire. The Strait of Hormuz, a narrow waterway where about 20% of the world's oil passes through, remains under threat. That's why crude oil prices are up roughly 30% from earlier this year. Gasoline has climbed above $4 a gallon. This spike in gas prices was the biggest single-month CPI jump since June 2022. I was working with a client recently who asked, "Why does a war thousands of miles away affect my grocery bill?" The answer is oil. Oil is in everything: transportation, packaging, fertilizer. When oil gets expensive, the cost of moving and making goods goes up across the board. Second, AI infrastructure spending. Broadcom signed a deal with Google to supply custom AI chips through 2031. Amazon's AWS cloud business is now running at over $15 billion a year in AI revenue alone. Custom chip orders are above $20 billion in annual run rate. Amazon plans to spend $200 billion on capital projects in 2026. That is not a guess or a forecast. That is money already committed. And that's exactly why chip stocks rallied so hard this week. Oh, what is ahead? Two paths. The positive path: credit quality stays solid, oil prices stabilize, the ceasefire holds, and bank earnings come in strong. If those things happen, this rally has legs. The risk path: oil spikes again, banks report weaker guidance for the rest of the year, and war costs start spreading into broader economic damage. That would put the brakes on everything we saw this week. The earnings calendar next week is packed. Goldman Sachs reports Monday, JP Morgan and Citigroup on Tuesday. Netflix, Johnson & Johnson, and PepsiCo are also on deck. We will also get the Producer Price Index, which measures inflation at the wholesale level before it reaches consumers. What we did for a client last month was map out exactly which earnings reports affect their holdings. That way, they knew in advance which days to pay attention to and which to ignore. That is the kind of preparation that keeps you from reacting to noise. Quick break before we get into the portfolio. If you are watching this every week and getting value from it, do me a favor. Hit subscribe so you don't miss next week's review. And if you want to see how we build a portfolio that weathers weeks like this one, watch the video I am going to link at the end. It walks through our 3 buckets approach to picking companies. Now, the portfolio. Here are the top 5 performers in the value-aligned portfolio this week. Broadcom led the pack at plus 18.12%. That Google chip deal we just talked about? This is the stock that benefits most directly. Year to date, Broadcom is up 7.35%. Amazon gained 13.64%. The $200 billion CapEx commitment and the AWS AI numbers gave investors confidence. Amazon is now up 3.28% for the year. AMD rose 12.66% for the week and is up over 14% year to date. ASML, the Dutch company that makes the machines that manufacture advanced chips, added 12.23% and is the standout year-to-date performer at plus 38.18%. TSMC, the world's largest chip manufacturer, rounded out the top 5 at plus 9.31% for the week, up nearly 22% for the year. Notice the pattern. Every single top performer this week is tied to AI hardware. These companies are selling real products into confirmed orders. Now, the other side. We show you both, always. ServiceNow was the biggest drag, falling 18.63% for the week. Year to date, it is down 45.82%. That is a painful number. ServiceNow sells software that helps big companies manage their IT operations. Investors are worried that AI tools can do some of that work cheaper. Salesforce dropped 11.87%, bringing its year-to-date loss to 37.73%. Accenture fell 10.83%, down 33% for the year. Roper Technologies lost 4.12%, and S&P Global slipped 3.65%. The theme is clear. Software, consulting, and data companies are under pressure. Investors are asking a hard question about each of these businesses. Can AI replace what they sell? We believe the answer for most of these companies is no, because they have deep customer relationships and switching costs. But the market is pricing in the fear right now, not the reality. 3 stories drove this week's action. Story 1, the Broadcom-Google deal. Google committed to buying custom AI chips from Broadcom through 2031. That is a 5-year guaranteed revenue stream. On top of that, Broadcom is building capacity for Anthropic, one of the leading AI companies. When a customer signs a deal that long, it tells you the demand is real, not speculative. Story 2. Amazon's financials. AWS AI services hit a $15 billion run rate. Custom chip orders crossed $20 billion. Andy Jassy, Amazon CEO, said it directly. We are not investing on a hunch. When the CEO of one of the world's biggest companies says that, it carries weight. Story 3. The software sell-off. The S&P 500 Software and Services Index fell 8.7% this week. AI is changing how companies think about buying software. If an AI tool can do in minutes what a $200 per seat software license does, the old pricing model breaks down. That repricing is happening right now. Here is the entire week, distilled into one chain of events. It started with the ceasefire. A fragile truce in the Middle East calmed the oil market enough to reduce some fear. That opened the door for the core CPI number to matter, and core CPI came in calm at 0.2%. With inflation fears easing, investors focused on the AI spending announcements. Broadcom, Google, Amazon's $200 billion capex. Those confirmed that AI demand is backed by real cash. That cash flowed straight into hardware stocks, chip makers, foundries, equipment companies. They rallied 15% to 25% in a single week. At the same time, capital moved away from software companies whose future revenue depends on promises, not signed contracts. That is the repricing. One sentence sums it up. Money moved toward funded demand and away from long-duration promises. 3 things to carry with you. 1. The market trusts funded AI spending over long-duration software promises. Companies with real orders and real cash commitments got rewarded. Companies selling future growth got marked down. 2. Headline inflation stays at the mercy of oil and geopolitics, even when core inflation behaves. The headline CPI number scared people this week, but the underlying trend was fine. Know the difference. 3. Next week's earnings and PPI data will decide whether this rebound sticks. Bank earnings set the tone for the economy. PPI tells us what inflation looks like before it hits consumers. For long-term owners like us, the lesson is the same as always. Know where the cash commitments are real and where the pricing power is intact. That is what separates an owner from a trader. If you got value from this weekly breakdown, you are going to want this one right here, where I walk through our 3 buckets approach to building a portfolio of ownership companies, monopolies, and cannibal companies. It explains exactly why we pick the kinds of businesses we pick, and how that framework held up during every downturn over the past 40 years. I will see you in the next one.